Hey everyone, welcome back to the channel, your number one source for income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. And speaking of high-yield funds, one sector that in the stock market that's really known to provide typically high dividend yields, not only that, but also give you some defense and some stability in your portfolio is the utility sectors, of course. And it's not that hard to figure out why, right? Everyone needs electricity, everyone needs their phone and their internet connection nowadays. So that's why it's considered a defensive sector, because everyone needs these services all the time, no matter what's going on, right? But utility sector as a whole in the stock market has not really performed that well, or has underperformed as interest rates have gone up in the last year or two, and we're going to try to figure out why in this video. So it turns out that this is actually very common, as a recurring theme in the utility sector, that they underperform when interest rates go up. So Harvest, which is the sponsor, who is the sponsor of this video and a good friend of the channel, and I'd like to thank them for sponsoring this video, has already done the research for us. So let's take a look at what Harvest says about this, and more importantly, is it time now? Is it a good time to actually invest in the utilities sector? Is it a good opportunity? Let's figure this out together right now. So is it time to get into the utilities sector? Is it a good time to invest now? And why are the utilities go down, or why do they go down when interest rates start going back up very quickly? So I want to share with you an article where a portfolio manager at Harvest explains this. So I will put the link to this article in the video description below, and in case, and I'll read some excerpts here, the ones where I feel, or the parts where I feel are important. And if ever, you don't like reading, you rather listen, you could actually go to this video here where that same portfolio manager actually discusses basically the findings of this article. So I'll put both links in the video description below. You could read the article, you could watch the video, it's up to you, but very interesting stuff here. You'll learn a lot on the utility sectors like I did. This is what I love about do-it-yourself investing. There's always more to learn. So this article, the title is, "Do Peaking Interest Rates Mean Good Time for Utility Stock?" And the gist of this article is that basically on November 14th, following the report that US inflation has fallen faster than expected, or basically what they're trying to say is US inflation is starting to get under control, the S&P 500 Utilities Index, or the utility sector of the S&P 500, jumped almost 4%. So it says here, for a sector like utilities, known for its stability or defensive nature, right? That kind of swing is notable and largely due to a growing consensus among equity investors that we have hit peak interest rates. So they're speculating here, or they're assuming that we're close, or we are at the peak of the interest rate. So what does interest rates have to do with utilities anyway? So it's very interesting. They go on to say that utilities are an almost textbook example of an interest rate sensitive sector. So I didn't know how, personally, the extent of how utilities are really tied to interest rates, but I guess they are here. So these are the companies providing energy, heating, telecommunication services, pipelines. They tend to have steady demands, cash flow, and capital intensive operations, right? Steady demand, obviously, because everyone needs these services. So that results in what can be considered bond-like performance. And we all know what happens to bonds when interest rates go up, when they rise. Bonds go down, but the opposite happens when rates start to fall, right? Bond prices go up. So they're saying that the utility sector, utility stock, behaves very much like the bonds sector rather, in that article. And they go on to say, so Harvest did a lot of research on this, and I love these little tidbits of research that they do here. And again, I'll put the link to this article and this video, which it's discussed, in the video description below. But basically, they conducted studies on past interest rate cycles, right, when they go up, and look at the utility sector. They look at 8 different rate hiking cycles with soft landing and hard landings. And for every example, whether the economy fell into a recession or not, so soft landing or hard landing, the transitional period where rates hit their peak, or interest rate hit their peak, was positive for the utility sector, just like it's happening now, basically a month or two ago, right? Like we saw at the beginning of the article. So they go on to say that even if rates stay higher for longer, hitting peak rates should be enough to drive some positive performance for the sector. So in short, everyone, the utility sector does behave like bonds, and once interest rates have peaked and they start going down, that's typically positive, or some good times coming for the utility sector. And the proof is in the pudding, right? If we look at the HUTL and ZWU ETFs, these are the ETFs we're going to focus on today. So HUTL is the Harvest Equal Weight Global Utilities ETF, which has 30 utilities from all across the globe. And you could see here, as soon as the interest rates, or there's some talk of interest rates maybe peaking, utility sector has gone up. Same thing for ZWU, which is the biggest utilities covered call ETF in Canada. You could see the same type of behavior. So it might be a great time to get into utilities, everyone. It's a defensive sector. I know many of you are my audience members. They're in the demographic where you're a bit older. Maybe you're thinking of retiring or you're already retired. So these could be some great ETFs to invest in now and put in your RSP or TFSA or your Lira account. And we're going to focus today on, of course, Harvest's covered call utilities ETF, which in my opinion is one of the best in the game here when it comes to utility covered call ETFs. HUTL, so that is the stock symbol. It is listed on the Canadian stock market, so you buy it in Canadian dollars. HUTL, Harvest Equal Weight Global Utilities Income ETF. So let's take a quick look at this ETF together, guys. There's a lot of positive points that I'm going to talk about in this ETF, but we'll take a quick look and we'll actually compare it or do some comparisons to the biggest and most popular utilities covered call ETF, ZWU, right? Which we all know. So HUTL, first thing you'll notice is the approximate current distribution yield of 8.36%. So very, very nice high yield now. This is, of course, as of January 15th. It's going to change daily based on the stock price, of course, but very, very nice high yield. If we look at the overview here, this has, first of all, a low management fee of 0.5. I did check the MER. It's 0.71 MER, so very, very competitive. It's basically an identical MER to the BMO one. So very, very competitive management expense ratio here. And this has 30 stocks, everyone. So 30 stocks, and if you click on portfolio, you'll see all the stocks. They're all utility stocks, and of course, utilities includes electric generation companies, telecommunication, and also some pipeline companies. Those are typically the three type of stocks considered under that utility umbrella. But what I really find special about HUTL is you have good regional diversification. You could see the geographic breakdown here. So you not only have North America, although North America here is the biggest chunk of the portfolio, but you also have a lot of utility companies in Europe as well. You see that here. So if you look at the holdings, you have really a nice mishmash of utility companies, not only electric utilities, but also telecommunication. If you just click on sector, you could sort them by sector. So of course you have pipeline companies like Enbridge, Pembina, TC Energy, the three biggest in Canada. You also have Kinder Morgan and some big ones in the US. But you also have some lesser known electric or utility companies outside of North America. You actually see the companies here: National Grid PLC in the United Kingdom, one from Germany. You have Brookfield Renewable from Canada here. Here's one from Spain. Duke Energy, very big one, electric company in the United States. Here's Emera. Of course, you'll find some Canada as well. But there's also, what I really like is a lot of telecom companies, all right, like AT&T. You'll recognize a lot of them, like AT&T, and of course Bell and TELUS. But there's also a lot of different ones outside of North America. So a really nice diversification here, not only in terms of the utility sector itself, but also region-wise. So HUTL, really good ETF to consider now if you want to get in. If you're an income investor, of course, you don't mind having covered calls on the sector, which translates to a really nice high yield of 8.36%. So let's just do a quick comparison of HUTL to the most popular utilities covered call ETF in Canada, ZWU. And I was pretty surprised because not only does it have the exact same MER, but it also has a little bit higher yield. You see here 8.03. Of course, this is as of January 5th, so you could always calculate it yourself. But right now, as of these numbers that I'm showing you here, HUTL has slightly higher yield, or you could say they're pretty close. But if you look at the performance, if we look at the 1 year performance of HUTL in the last year, it's 2.16. If we look at the performance of ZWU here, you see that yeah, and it's both as of end of 2023. So we are actually looking at, the correct dates. So you see in the last 1 year, 2.16%. And then ZWU minus 2.58. If you look at the 2 year, it's minus 3.3. And then the harvest one is better at minus 1.19. If you look at the 3 year, 4.34. If we look at the 3 year here at 2.66. So listen, I'm not saying one ETF is better than the other, but I'm just showing you the performance, and HUTL is very, very competitive. Not only with the management fee, the MER, but also their performance as well. Another advantage I feel HUTL has over ZWU is it has more regional diversification. ZWU only has North America. Basically, if you just scroll down, you could see the breakdown over here. 67% Canada, 33% United States. So a little bit more diversification, regional diversification with HUTL, which I feel is good if you're looking for that. And another thing, and of course, we're income investors, what really matters is the monthly distribution. HUTL is about to celebrate its 5-year anniversary, and it's never had a change in distribution. It's always been the same monthly distribution since the beginning. So this is, of course, Harvest ETFs are known to have really, really good consistency with the monthly distributions. This is very important if you're a retiree, right? Consistency is very, very important. ZWU is fairly consistent as well, but not as much. Like you could even see in 2023, it was 8 cents a month, and then it goes to 7 cents a month. So throughout the years, ZWU has been around for a long time. There has been a little bit of changes with the distribution, whereas HUTL has not. So that's another advantage. So there's really quite a few advantages I see with HUTL. It's a great time to invest in utilities. And another thing which is really cool is that there's a leveraged version or an enhanced version of HUTL. It's HUTE. So HUTE is basically HUTL with 25% leverage. If you actually look at the portfolio, it basically holds approximately 125% exposure. That's where that 25% leverage comes in of HUTL. So think of owning HUTL plus 25% more, which is going to translate, of course, to a higher distribution yield. So you could pretty much get with HUTE, the leveraged version, a yield of over 10%, which is absolutely fantastic. And this one as well, if you look at the distributions, have remained consistent. So in my opinion, guys, it's a great time to really think about and invest in the utility sector. HUTE, awesome, very high yielding fund, just a leveraged version of HUTL. If you're not comfortable with the leverage, you could always go with HUTL. And by the way, this ETF, HUTL, is included already in Harvest's diversified monthly income ETF, which you guys know I love and I own myself. So if you look at the portfolio of HDIF or the breakdown, you will see HUTL is one of the 8 ETFs inside of it. So if ever you don't want to get specific utilities exposure, you want to get it indirectly, HDIF is also a great option because you do have that utilities ETF included in this ETF, and the yield for HDIF is over 10% as well. So HUTL, awesome option if you're looking to get a basic covered call ETF. Great time to get into it. You'll get about 8% yield. HUTE, if you don't mind a little bit of leverage. My opinion, if you're going to hold something, quality stocks for the long term, I personally don't mind a little bit of leverage because you're going to get a little bit more yield. And by the way, if we look at the performance real quick, if we look at the last year, this one hasn't been out for that long, but if we look at the performance, the 1 year is 238, and if we compare that to HUTL, it's a little bit lower at 216. So HUTE is performing a little bit better than HUTL, which makes sense because there's leverage. So if it's a positive time frame, it should be more total return. But either way, you could select which one you want, the leverage version or the non-leverage version. So again, I want to thank Harvest for sponsoring this video. I think they have an awesome utilities covered call ETF. Defensive sector could be a great opportunity to get into it now, everyone. And again, if you're interested in learning more about this sector and want a little bit more details about how interest rates impacts the utility sector, I will put the link to this article and the video where they actually discuss it live in the video description below. So make sure to check it out. And if you're interested in getting more Harvest insights, just go on their website. If you scroll all the way down, you'll be able to, sorry, over here, if you scroll all the way down, you could just subscribe to their monthly updates, to their newsletter. I strongly suggest it so you're informed every time they come out with an article. But Harvest does have a lot of great articles, education here, insights. So I strongly suggest you sign up to the newsletter. So that's it for this video. Thanks for watching. Give me a thumbs up. I would really appreciate it, and see you next time.